Hey everyone, I hope we're doing well and welcome back to the Lagforex channel. Today on a Wednesday, is a learn to trade video going up on the channel. Now today I'm quite simply going to be talking through the importance of liquidity in the market and why me as a smart money trader needs to understand liquidity and where it lies in order to be profitable in these markets and know exactly where price needs to go, given the fact we know where liquidity lies, and we can therefore use that as parameters when it comes to trading. So I just have the Aussie dollar to US dollar chart in front of me. Now, I was just going to use this as an example, absolutely no reasoning behind that. This can be done on absolutely any chart in any market. There's liquidity in every single market. Liquidity is built up in every market, so you can apply this to anything. So for those of you who don't know what I mean when I'm referencing liquidity in the market, so liquidity represents areas in the market where a lot of money lies. So quite simply, that could be stop losses, pending orders, whatever that may be. But it's mainly done at equal highs and equal lows. This is areas where a lot of people have been induced into the market, have been induced to place a position, and have therefore got a stop loss maybe above that structural high or below that structural low. And therefore, we have a lot of liquidity at that level, because a lot of people would be pulled out of the market if that level was to be surpassed. So looking in at this market now in front of us, the AUD to USD, you can see I have this box here with the money signs within it. Now, what this is representing is a level of inducement, which therefore creates an area of liquidity. So what I mean by inducement is that when price is tapping into this area, it is inducing sellers. So of course, in this case, price is moving up to it, reversing, moving lower, so it is inducing sellers into the market. What this means is that when price taps this zone, technical traders are thinking that this is a level of resistance. They want to get in on a reversal, place a sell position, and they're being induced to do that by the way that price action is being delivered at this area. Now you can see we have many touches within this area. Now because so many people have been induced here, we can assume that everybody that gets in on a position at this area has put their stop loss above this area, above the highs, in the assumption that if it was to break these highs, they no longer want to be in the trade because it is no longer a confirmation sign of bearishness. So that is the main type of liquidity I am looking for in the market. It's where we have many equal highs or many equal lows, as can be done on the flip side. And what it quite simply does is it induces early sellers or early buyers into the market with the purpose of building as much liquidity as we can, manipulating them out, which is quite simply the purpose of these smart money operators. Now there's also many other examples, and it is to do with structure. So looking at this chart, we know we are in bearish structure. Now that I zoom out, I can tell you this is the extreme high. This area is the extreme high in the market, and since setting that extreme high, we have been breaking down. We have been breaking the lows, protecting the highs, putting in bearish structure. Now, what this means is that we are running the liquidity on the downside. So just like when we have these equal highs and we have liquidity at that area, each time we set a low in the market, so for example, this lower low, and this lower low, what we're doing is we're once again bringing liquidity into the market, because people would have got involved on buy positions on this reversal and put their stop loss at that low. Now, as a result, we have liquidity at these low points. So when we are bearish, what we want to keep doing is running the liquidity to the downside and protecting the highs. Now, the reason we want to protect the highs is because this is where the smart money operators have executed sell positions. Now, of course, throughout the entire scheme of the market, the up down movement, they are placing both sells and buys. So for example, in this accumulation down here, they would have placed buy positions, but what they will do is when they're moving down, they will close that out at break even. They will not be in too much of a loss from these positions, but from this major reversal point, from the high, the extreme high set in the market, they would have placed their major sell positions from here, evident by the momentum on that initial move down. They will have large sell positions open here, and they will want those to keep profiting for as long as they possibly can. So what they're going to keep doing is running the lows, keep moving price lower in order for them to profit. Now, the reason they don't just drop price in a straight line is because we still want to continue creating manipulating and removing liquidity from the markets as we do this. So as I was stating, each time we set a low and we reverse for a correctional wave, we're introducing more liquidity, and then we can run more liquidity out of the market and introduce more supply in this move lower. Now, in understanding what liquidity needs to be ran, or what liquidity the smart money operators are looking to run, we can understand the direction of the market and the most probabilistic future direction of price in that market. So, for example, once we start seeing the liquidity lows be broken, we can keep assuming that price will do this moving forward until it was to hit some major point of interest. Now, price is never going to move down or move up for absolutely no reason. It's always going to come to a point of interest in the market, whether this be a supply zone, demand zone, market inefficiencies, whatever that may be. So we can make the assumption that this major extreme high will be protected and will continue to run the liquidity lows until we reach a relevant point of interest. Now, this doesn't mean that as we move down here, these highs, these intermediary highs, always going to be held. As I said, this is our extreme high, so we can argue that as long as the extreme high is held, it could just be seen as our impulsive wave down, and then this is a retracement, and then the next impulsive wave down. Now, this, of course, is the fractal nature of the markets. So within these moves, so within this impulse, within this correction, the reason why, as I said, it's not just a straight line like this, and when we move more fractally and fractally further, we see structure, is because that is a process of introducing and clearing liquidity. So it could be that as of now, we can assume that they might want to protect this low and start running the highs because they want to now clear all of the liquidity on the upside. So each of these, what were protected highs, again, they all have liquidity above them. Now what they're going to want to do is run past through as many of those as possible. However, they will still want to protect this high because this is where they executed that major sell position, and they don't want to be in a loss on this. They want to continue profiting longer term. So what they may do is they may bring price down, as we say, protect that low now, run all the upside liquidity, which is all of the highs within this point. This all acts as liquidity. So many different points that they can run. They've already ran these ones down here. And they may want to continue moving further up to clear all of these out. They will tap back in to the supply zone. And what this does now is it allows them to open even further positions at the best possible price. Now, if they were to continue running price lower and never had this wider scheme retracement, they would have been getting lower prices. Now, what this means is that that position hasn't got the most desirable entry. However, if they are to bring price up, they're gaining a 2-for-1 because A, they're blowing through liquidity, removing demand out of the market, and then coming to tap into here, introducing more supply by executing another large position, and then they can start to run those lows and keep profiting from this bearishness moving forward. Now, we have to understand that the reason any of this happens is to do with liquidity. The market is constantly creating and clearing liquidity. That is the purpose of every single movement we see within the market, and we therefore need to understand where liquidity lies to understand where price is more than likely going to want to go moving forward. So we must understand that the more liquidity that we create in an area, the more concentrated an area is with stop losses or other liquidity types, the more likely it is that price is going to want to run that. So the reason why this is seen as a point of interest and something I have marked out on my chart is because, as I said, there is so much liquidity here, because there's so many equal highs, so much inducement happened, there is so much more liquidity, and as a result, price is not going to want to move too far away from this before clearing it. You have to understand that these central banks, the smart money operators, they understand and can see exactly where all liquidity lies in the markets. They have special tools to help them with this. So for example, at this region, there will be something on their chart, like a box like I have, that shows them that so much liquidity in the market lies at that region. Now, their main purpose is to run this liquidity before doing anything else. And their whole strategy is to use the liquidity to trade from. So because they know that this is a heavy area of liquidity, it is more than likely now, as I said, that we may start to protect this low in order to run the liquidity, mitigate positions up here, and then resume in with the initial movement they wanted to do. So it's definitely something you need to be looking out for. I know a lot of technical traders use things like this, your equals highs, your equal lows, as great points of interest. But what do you think fake outs are for? The reason we see fake outs at all is because we are clearing liquidity. Now, that isn't always going to be a static level. We may even see trend lines get manipulated. If I just draw this up on the chart to show you what I mean. So just looking at this on the chart, this would be seen to many technical traders as a fake out. Now, this is not at all what it is, because this structure is still bearish, okay? This high was still protected. Price never came to surpass it. All it did was clear the liquidity of this trend line. They would have seen in the market that many people were looking to be sellers from this area, and we had a lot of liquidity at this region. And the reasoning for this movement was to clear that liquidity before they can continue profiting on their own sell positions. Anytime you see something that you deem as a fake out, understand that price has more than likely cleared liquidity. In order to continue that movement down, a fake out is actually a great sign of a continuation of the trend, because it has cleared upside liquidity and introduced more supply if it's a downtrend, or on the flip side, it may have cleared downside liquidity and introduced more demand in order to help with the move. To any smart money traders, this is seen all the time in Wyckoff. The typical stages of a distribution, moving up into our buying climax, our automatic reaction. We may have some secondary tests. We then have that up thrust, sign of weakness. We come back, we test that as a last point of supply, and then we begin to break down. Now, what we have here in that phase A, in that buying climax, secondary tests, secondary testing B, whatever this may be, the purpose of that is to build liquidity. This is something that's not actually included when people learn Wyckoff, and something that is definitely needed, because we have to understand that the reason this happens, the reason we have an up thrust, is to clear liquidity. We mislead people of the future trend. We first induce many sellers into the market. They think we've reached a level of resistance. They want to get involved in sell positions. But before that happens, we blow through that. We take everybody out of those sell positions. We may then even typically show signs of a break and retest and a continuation higher, once again manipulating early buyers out of the market, before ultimately, as I said, we blow through all of that, take out all of these early sellers, these early buyers, and then on top of that, we then blow that downside liquidity and remove anybody else that may have been in the market. Now, this is just a brief explanation of why the market does what it does, and understanding the reason all the moves happen is based on liquidity, where it lies, and the fact that the smart money operators are always wanting to clear liquidity in order to help themselves profit. This is a concept you must understand if you want to be a successful trader. So I hope you guys have enjoyed. I hope you've managed to learn something from this video. If you have any questions about the way I've explained this or anything else, make sure to drop me a message. For now, thank you for watching, and I will see you in the next video on the Lagforex channel.